Welcome, one and all. I'm Ian Lee. I got my fearless leader with me, Brett Andrus. And today is all about you guys talking about how we can buy more real estate, how you guys can buy more real estate. So, Dan, go to the next slide if you would. This is for you guys. For people that are looking to buy their first home or add to their portfolio, I like to add all these additional things here to kind of define, pick which one feels like it's right for you. And I said this in the email that we sent out earlier in the week, NAR and a few other independent sources talk about the ridiculously low percentage number of real estate agents that buy investment property. And it seems baffling to Brett and I on a really pretty consistent basis, like why that's the case. Because if we're honest, of everyone in the transaction like cycle, yeah, Brett and I might be really dialed into like where the market's at as far as like rates are concerned and like what direction that's going to go. And we see so many appraisals all the time because our revolutions of like the number of transactions that we're doing during the year is normally higher than what a real estate agent is doing. So we kind of see that stuff, right? But you guys have this like special insight, the heartbeat of what's happening on the ground floor. You guys see the ebb and flow of where the property deals are coming. And it's impressive, I think, how few realtors can follow their instincts and capitalize on that for generating deals for themselves. So Brett and I spent a little bit of time talking and interviewing and sending out quizzes and polls and whatnot to ask a bunch of real estate agents like why they don't invest in more stuff. We asked them questions about, why don't you think you can get a loan for this or for that and whatever and blah, blah, blah. And what we came to the realization of was that we had a wild amount of myths and a wild amount of facts that we wanted to address. And so that's what we're going to do today on the call. So next slide, we're going to start with this, this first, next slide, Dan, if you can, myth and facts about buying real estate in 2023. That's right. This is for this calendar year. I know we're kind of coming up to the end of the year. So I don't know, we'll add one or two more myths. And then when this hits YouTube, we can put it up for 2024. Next slide, Dan. And so we're going to probably start with our first biggest myth that we hear from real estate agents all the time. And it's that they feel like they need to have their current job for a minimum of 2 years before they can obtain their mortgage. And the truth is, that's actually a myth. That is totally a myth. Lenders look at generally overall a 24-month period of income related to work experience. And this is if you're going conventional, of course, right? And if you were, a lot of times for real estate agents, you work at one brokerage and sometimes you're 1099 there. Then you leave and yourself, maybe you go somewhere else and now you're W-2, go to a different place and now you're 1099. And we've had some experience with real estate agents that have done that because of the way that the different brokerages are set up. It's possible to get exceptions to allow you to still be in conventional land and get a loan for that. But even if we don't go into conventional land, even if you haven't been a real estate agent for 2 straight years, you can go. There's loan products that exist in the non-QM space, 1099, bank statement, and DSCR loans that will still allow you to obtain a mortgage for primary residence and for investment property. Now, the treasure trove of like the reasons as to like how that all like works. Dan, go back one slide again. Is, can be a little bit hairy and they're very specific for every individual, borrower themselves. But I'm going to shut up right now and let Brett explain a little bit more on the details around when we talk about, Brett, to clients and real estate agents, and I'll pose this as a question to give you a little tee up here. But we encounter this 2-year minimum requirement all the time. So define it for us and give us a little bit of insight on your experience having real estate agents have to, fulfill that requirement.
One thing I do want to make sure we understand here is that the 2-year requirement is a thing on a conventional loan. If you are a commissioned employee or self-employed, there has to be a 2-year history. Okay. We can get away with 1-year tax return if we have 5 years in the business. Okay. So sometimes what we look at, if we need to get around that you're new to the real estate world and new to drawing commission, we'll look at a DSCR or a bank statement loan. DSCR is going to be debt servicing as long as the the income and the rental property is covering the debt, we should be fine. But conventional does require that you have if you're self-employed, you have to have 2 years.
Awesome. Go ahead, go to the next slide, Dan. All right. So another question or response, I should say, we got from a bunch of realtors was that they felt like only first-time home buyers could buy a home with 5% down. And I found that surprising. I felt like we feel like we do a good job of trying to communicate that, but I was really surprised at the number of agents that were aware of this. And, for the most part, I would say that it actually had to do with either brand new agents or agents who had been in the real estate game for quite some time that had just, I don't know, for whatever reason, they just haven't worked with a ton of first-time home buyers. And so this wasn't like on their purview. But Brett, what are all of the ways that a first-time home buyer can come up with a down payment amount? What are all the different percentage numbers?
Well, so for first-time home buyer, so here's the thing. One thing I want to get in everybody's head is that the idea of first-time home buyer, there's actually 1 or 2 programs that are only for first-time home buyers. First-time home buyers is more of that is more of a marketing term than anything. Okay. If you're going conventional, your minimum requirement under most circumstances is going to be 5% down. Now, there are certain ways to do a 3% down on a conventional if you meet certain income guidelines. Okay. But kind of keep the number 5% in your head if we're going conventional. On a primary residence, minimum requirement, 5% down. Okay. FHA is going to be 3.5% down. So if you're buying a primary residence, we've got 2-year income, we can do 3.5% down on an FHA. And if you're a veteran, we can use still, it doesn't matter that you're a real estate agent now. If you used to be a veteran in the past, awesome. We still go, use your VA loan, 100% down, no down payment required.
Yeah, absolutely. I love the shock and awe sometimes when I talk with home owners who bought their home whatever number of years ago, when like the first time home buyer programs were more of like a dialed in thing. They were way more like options, right? And so a lot of the programs that allowed those like lower down payments, like they're not specific to first time home buyers. And it's a really big positive thing that we see a lot of the clients go through the One Property Way program that leverage the same, which is why we put that tip down there, right? They buy a house with 5% down, live in it for a number of years. They're ready to buy their next one. And they go and buy that next house with 5% down, and they convert that exiting property into a rental, right? And that's a wonderful strategy. And candidly, what ends up happening is that's a really solid strategy to buy an investment property for 10% down, I guess, if we're arguing. But for the realtors here that are listening to this, when you have clients that are maybe give you this as an objection as to why they aren't ready to move, oh, I don't have 20% down, or how could I possibly do that? We don't have very much, whatever, blah, blah, blah. You can fit into the conversation space. The reality that it's okay if they convert their old property into a rental and they don't have 20% equity yet. One, that's okay. And two, the next property that they go buy, they are still comfortably capable of doing 5% down, right? Or 3.5%, I guess, Brett, like you said, if they go
with FHA. Now,
FHA.
The difference, just to also put out there is that, if you're putting down 20%, you're avoiding MI. It used to be, the big, I've been doing this for 22 years now. And it used to be the big fear was MI. We don't want to pay MI. We're going to put down more money to avoid paying MI.
Right.
Makes sense under certain circumstances, but you'll find that going conventional, good credit score, your MI is not that much. And I personally, would like, especially in a market where we're seeing equity growth, sometimes will tell clients, hey, keep that extra, 15% in your bank account and pay the extra $110 a month in MI, because the difference isn't saving you money. You know what I mean? Like, I'd rather see you be liquid with a 15%. So big sort of, just don't be scared of MI. There's a lot of different little different programs we can use with MI to lower that payment. That's actually where you see more of the first-time home buyer stuff applies in the MI space, in the mortgage insurance space. But MI is it's an evil. It's out there, but it's not as bad as it used to be.
Yes, like. So the next question that we kind of got asked hand over fist, right, was that lenders were only going to use net income when they were qualifying for a mortgage. And when we say net income, we're talking about self-employed real estate agents, those that are on like 1099 and whatnot. And this really depends on how you file your taxes as a 1099 employee if you're going Schedule C, or if you have your everything's funneled through an LLC. The net income is really not the standard mechanism that we use in conventional space to help qualify you for the mortgage. But if we are in non-QM land, there's a handful of programs that allow you to use gross before you have any of these deductions to help you qualify for a mortgage. So what's important is the answer is that this is a myth, that this is not the only way to do it, but that if if you're sitting down and you're planning with your mortgage provider, hopefully it's Brett and I, but whoever it is that's planning it out, that they're looking at it from all these different angles, because contrary to popular belief, it's not just your net income that helps you qualify for a mortgage. There are a handful of different ways that have more to do with how you're filing your taxes than they do with just exactly what your net income is.
Yeah, let me comment on that real quickly.
Yeah.
One thing that we're kind of seeing right now is, with rates getting tight, everything getting kind of ugly, everything's slowing down, right? What I'm seeing is lenders are hurting. They just are. So in that space, they are trying to open up the net to catch more fish, right? That means we're seeing more programs come online in what's called the non-QM Alt-A space, which means that they're non-traditional, non-conventional, non-FHA, non-VA guidelines. They're non-Freddie and non-Fannie. They tend to be a little more creative in what they allow for income. It reminds me of, I hate to use the word subprime, but it's kind of what the old subprime days were like, back in 15 years ago when it was harder to get a mortgage. Companies open up their doors to get a little more creative. And we're kind of seeing a rebirth of those things back into the market. So in a space where we don't want, we can't qualify your net income and go conventional or FHA, we might look at one of the, non-QM loans as a potential to get you in. Eventually, looking at something down the road to refinance you out of that.
All right, slide. So this was an interesting question that we had come up with from a handful of investors that we knew already had owned tons of property. And Brett, you're probably already thinking of the 3 or 4 clients that we've had in the past year or two that we know that we crossed this bridge with. But surprisingly, a lot of realtors think that you can't own more than 10 rental properties with what I'm calling an A lender, Brett, which is just like a traditional, conventional lender. And this is actually, there's kind of 2 sides of this coin. This is fact and myth is the truthful answer to this. And so you can actually own more than 10 rental properties at a time, but the way that it's set up has to be unique. So Fannie and Freddie, for instance, will allow you to have 10 mortgages at any one time. Now, it's possible that those mortgages are on single family residences. It's a triplex, a duplex. And so sometimes when I talk to investors, they're like, well, I already own 8 doors. They say doors instead of, properties. And once you hit 10, yes, Fannie and Freddie are not going to extend your kind of at that cap. So you can start considering some non QM product space, because they don't have those types of requirements. How? Now, here's the deal. A lot of times we talk with investor realtors, and they're like, yeah, I talked to my local bank, and they have a limit of 2. And I just use that as the example in the slide here, but that's because that's what the bank has as their specific rule. Now, if let's say you got a loan from Brett and I, and the first 3 properties that you bought were all with one specific investor, but the next time that you came to us, we used a different investor, that's okay. According to each of those investors, they may have the same rule that the bank has. Oh, we're only going to lend to this specific borrower 3 times, but that's all right. We have a portfolio of 37 different correspondent channels to connect you with a different investor that you haven't worked with before. And so this can be a little bit complicated, which is probably why there's so much uncertainty behind that. And so I'll let you lean into this here, Brett. But the tip that we wanted to leave with you guys is that, candidly speaking, the real way that we navigate this on our side when you come to us to help you navigate through this is making sure that your paperwork is hyper organized. The more organized it is, the easier it is for us to figure out and find that approval earlier on. So that we're talking about updated lease agreements, mortgage statements, property tax statements, all that type of stuff. when we try to engage and try to help you once you've had a handful of properties under the belt, it becomes a more difficult loan to do. And if that paperwork isn't like updated and you don't have the ability to get it updated really quickly, oftentimes we can spook or scare, or the lender feels like they've opened a Pandora's box, and subsequently you can find yourself, less likely to get an approval. Is the right way to say that.
Yeah, one of the things that you can think about is files are decided upon by underwriters. Underwriters are human beings. Okay. The more you go back to an underwriter and the more you provide them information, the more they're going to kind of Perry Mason it and get into it and find what's wrong with the file. So what we like to try to do at the beginning is get everything as clean as we can be before we even start looking for investment properties. Other little trick is, you'll notice on the slide, it says 10 mortgages. Okay. It's not 10 houses, it's 10 mortgages. Mm-hmm. So let's say you've got 3 properties that you bought 5 years ago, and you're coming up on that 10 mortgage limit. We'll say 3 of those properties are each at 50% LTV. But one thing you might think about doing is doing a cash out on 2 of them, pulling the cash out, paying off one of the mortgages, paying off one of the full properties, paying off a mortgage completely with the cash from 2 other properties or 3 other properties, therefore freeing up a chain in that 10 mortgage link, essentially. There's just a lot of different ways around it, but I always, it's all about planning, and especially the more properties you have, the trickier it can be. But if we go in with a solid plan, it makes everything easy.
Awesome. Slide. So the next question or concern or objection is that you need to have great credit and income to buy a property. And truthfully, that's a myth. As long as you have a 20% down payment and the property is in a marketable area and you have an exit plan, there are lenders in the non-QM space that will approve you. Now, will you like the interest rate? Probably not. But if acquisition is important because it's a deal that you found where you know that you're going to generate and make money on just buying the property because you're in the right place at the right time, then maybe it's okay to consider this as a potential option. Because remember, you buy property with the anticipation and the expectation of it, being fruitful for you for a long time. But your mortgage is not that long-term thing. You have the ability to improve it over time as the market reacts to it.
True.
Thanks, Brett. Slide. All right. The next objection was that you need to pay yourself more money to qualify for a mortgage. Now, this is an interesting gray area, but the answer is myth. Okay. I'm stating that it's a myth. And we get this question oftentimes from real estate agents because, their CPAs told them to do one thing. And we see an incredible amount of tax returns. And I'll just tell you this much, that a CPA is hired by you to help you minimize your tax exposure to the IRS. And very often, depending on how your taxes are filed, that comes in direct conflict with how much eligible income there is then to help you calculate and qualify for your mortgage. If you are working with a CPA that is not comfortable having a conversation with you on like how you can file your taxes to try to optimize your ability to qualify for a mortgage, then I would encourage you maybe to seek out counsel from other like CPAs that are willing to have this conversation with you. Because what's the answer? Well, the answer is yes. If you make yourself have more income on paper, you will pay more in taxes. But when you factor in the comparison to how much more money that might be able to generate you and your ability to purchase something, the payoff could be worth doing, right? And so remember, in conventional mortgage land, all lenders are going to use, if you're self-employed for sure, but any real estate agent, honestly, we're going to look at the 2-year average of your net income if you're self-employed. So you'd have technically higher personal tax income for 2 solid years. So if you factor in the business tax rate versus personal, it usually does make sense to take the higher tax rate and the higher rate on the loan and save the income tax. And you might just say, well, how is it going to be a higher rate? I thought you said that I need the income to qualify. Well, remember, there are ways to qualify based on your income in non-QM land that don't necessarily care about those lenders don't necessarily care about your IRS implications, right? And so is the rate going to be higher? Yes. But again, If you look at the big picture, then subsequently you might find that it's still worth it. If you've got a 3, 4, 5-year plan on how you're going to manage that debt, and your CPA and your mortgage specialist should be able to help you manage that, you might find yourself realizing that you don't necessarily need to pay yourself more to qualify for the mortgage at that current place in time. What do you think, Brett?
I know that this is probably our fifth slide where we have referenced non-QM. Okay.
Yeah.
I don't want this to feel like it's a non-QM push.
Oh yeah, totally.
I still 100% try to go conventional FHA and VA on the loans that we do. Non-QM is a
scary, hairy beast.
It's a deep ocean full of weird serpents. Yeah. We avoid it as best we can. Okay, it's a tool, and if the tool is used correctly, it can be a good tool. Within the conventional space, one thing I am going to go back on this slide. Traditionally, it's a 2-year average. Okay, so let's just say that you have been a realtor for 6 years, and if we can show that you've been a realtor for 6 years, you've been filing 6 years of self-employed tax returns with an automated underwriting approval, there's a good chance that we were only going to get a 1-year requirement in your tax return. Mm-hmm. So in that case, what we're able to do is use your most recent tax return and qualify for that income. So what that means is, let's say that in 2022, you showed income of $25,000. Okay. And in 2023, you showed an income of $100,000. Well, if we get on the automated approval and you've got 6 years in the business or 5 years in the business, we get on the automated approval, we can, based on factors, usually credit score and down payment, there's a really good chance that we're going to get a 1-year tax return requirement, meaning that we can use the most recent $100,000 tax return, which greatly increases what we can show. And this also goes on, this is not just for realtors, but this is for any particular borrower out there. If they're self-employed, if they've owned the business for over 5 years, we can get away usually with a 1-year tax return, which is pretty cool.
Yeah, super cool.
Again, it falls back into the box of planning.
Yeah, absolutely. Absolutely. We've even had realtors that we've worked with that are buying investment property that understood that this is the year. I've had a pretty good year. I'm going to just claim more income. I'm going to pay more in IRS taxes, but that means that I get to use this income for a full calendar year when I'm qualifying to buy property for the next calendar year. And they're just intentional about making sure that they buy as much as they can, or that they can qualify for that next calendar year. And then subsequently, they know the next following year, they're going to cool it and not going to buy that much. And so that's the year that they, work with their CPA to try to maximize not paying as much in tax. I guess the right answer there.
And there are certain things on your tax return on your, that you claim as a write-off that we can actually put back in. Depreciation is one of the big ones. Mm-hmm. So like if you're in a situation where you're claiming a couple, $10,000 in depreciation, we can actually put that depreciation back in to your net income number, which is again a cool little trick.
Yeah, and I'll say that those realtors that are on here that you have been working with your CPA for a while, go back and look at your tax return. If you filed as Schedule C, self-employed 1099, or if you did as like an LLC, go look inside your LLC tax filing. And in that section that Brett is talking about is all the deduction expense section. And we see a lot of CPAs take the easy way out.
Do a big lump.
And they just do a big lump. Yeah, totally. They just do a huge lump and they're like, look at attachment C. And, so the expenses is like a $200,000 expense line with no itemization, right? And then it's like, whatever, look at attachment A. And then they try to bucket it into generalized, almost like QuickBook, such sections of like what the expenses are. But when your CPA does that, we can't add anything back in like Brett just talked about. So if they itemize it correctly, the way that the IRS form is filled out, then we have a chance to add some of those deductions back in. So you're getting both. You're getting the benefit of it being added back to your income, and you still get to write it off on to the IRS. So again, how you divvy out those, ask your CPA. But we do see that laziness a lot of times from CPAs.
Yeah.
And so go look at your personal tax return, see if your CPA did that, and ask them next calendar year. Please don't do that. I would appreciate it if you didn't. So slide. All right, here's another objection. I need to have my taxes filed and my arrears paid before I can get a mortgage. Well, In conventional land, the answer to that is yes, 100% all of the time.
Kind of.
Please explain, Brett.
Okay. So in order to all right,
See, it's a myth.
Yeah, let's play this game. All right. Let's say it is September 2023 and you haven't filed your 2022 tax returns yet. It's okay. Then we're going to look at your 2020 and your 2021. Okay. I'm going to use a two-year average. Okay. So you don't have to have filed. Now, let's say that we get in past the corporate deadline of extension. Let's say it's, I don't know, October 30th, and now your 2023s are required to be there. Okay. And let's say that on that 2023, it's showing that you have you owe 50K to the IRS. Okay, fun. You can get away with a payment plan to the IRS showing that you have a payment plan in place and 2 payments being made. Okay, so that means you would have to have filed in August, make your 2 payments on it. We have to count those payments in your debt ratio. So like I say, the payment plan is $300 a month until you pay off the 50K, which would be a horrible payment plan. Let's say that's what it is. We have to count that $300 in your debt ratio, and we have to show 2 payments being made. Okay. If it's like, $5,000, that $5,000 can be paid at the closing table. So let's say your tax liability is $5,000. We can still close on your property with your 2023 tax returns with a check being written to the IRS at the closing table. Or you can just go DSCR where it doesn't matter.
Or you can just go DSCR. But again, I mean, I'll just be transparent, right? Like a lot of times when we look at a similar deal that could go conventional compared to one that goes non-QM, a lot of times we're seeing a 0.0 to 2 percentage points cheaper in conventional land than we are in like non-QM land. So it is not a cheap path to go, right? But
no, they're definitely non-QM is designed by lenders to, their portfolio loans. So they're going to make their money on a higher interest rate, and they're going to, and they're taking on, and since they're taking on the risk of saying, hey, I'm not looking at your anything other than on a DSCR, like does the payment cover the debt load? That's risky as heck, right? So lenders you're going to pay for it. So you can think of it this way: the riskier something is, and the more like information you're taking out of the puzzle and keeping it in the box, you're making up for it in the
rate,
the interest rate, what you're paying for it.
Slide. All right, we get this question a lot of times from borrowers, and we heard it on this survey too from real estate agents. We even have some realtor agents that are investors that have tried to do this a handful of times. They just thought they couldn't. I can't use my HELOC for my down payment. That is a myth. You can use a HELOC that you have on a property as funds for a down payment. The catch is we have to add what the new HELOC amount payment is going to be to your debt to income ratio calculation to make sure that even after you've done the HELOC draw, that you still qualify for the loan. And so this is a really smart, strategy for a lot of folks that don't want to keep a bunch of like outstanding, debt or loans like around. Or if for some weird reason that HELOC draw, based on how the payment is too much and doesn't help you qualify. We have also worked with clients in the past where what we did instead was the property that had the HELOC, we converted that into an amortized mortgage. And because of the way the math worked out, it was a lower monthly payment than the current first mortgage plus the HELOC payment was. And that improved the client's ability to qualify for the house. So what are your thoughts on that, Brett? I know we're, in this day and age, we see a lot of people really wanting to get HELOCs because they love the interest rate on their first mortgage, right?
Totally. Yeah. And so like, I came up in the business years and years ago when second mortgages and HELOCs were, a dime a dozen. You couldn't swing a dead cat without hitting a HELOC. Okay. After the mortgage meltdown, the first companies that got killed were second mortgage companies because mortgage meltdown happens, houses go into foreclosure, second mortgage companies don't get paid. Okay. Do you guys hear that? That's a really bad sound outside. Sorry.
No, we didn't hear it. No, I can't hear it.
So HELOCs became more difficult to get. They're starting to come back. They're starting to come back in vogue. And like you said, Ian, it's because, people, a lot of people have 2.25 on their first mortgage. Why touch it? Right.
Right.
In the right circumstance, it makes sense. Okay. But again, it's a conversation because there's drawbacks to HELOCs. Number one drawback to HELOC is the majority of HELOCs are monthly adjustable based on what prime's doing. And as in a market where we are steadily seeing rates going up, your HELOC's going up. So your payment's going up. And the majority of those HELOCs are interest-only payments. So at some point, you're going to hit a point, usually after 10 years, where you have to start making principal and interest payment. And usually they have a balloon on them sometimes, depending on the HELOC company. So you end up refinancing that HELOC into your first mortgage anyways. Now, the goal would be to refinance that HELOC into your first mortgage at a place where rates are lower. But if you're eventually getting there anyways, sometimes it makes sense to go ahead and nip it in the butt and take the HELOC. Because here's the thing, one of the things we look at is what's called blended rate. Let's say you have a house and let's say that it's worth $600,000. You bought it 8 years ago. Let's say you refinanced in 2020. Let's say you refinanced $150,000. Okay, at 2.25. Okay. Well, let's say right now what your goal is you want to upgrade and you want to buy this, a triplex, and you want to pull out an additional, $250,000 for the down payment on the triplex. Okay, so you're opening up a HELOC, the $250,000 line of credit. Okay, well that HELOC is going to be, it might get up in that 10-11% range for interest payment. Now you might have an introductory number where like the first couple months it might be low and then it goes up to 10-11%. Well, you're looking at then blended rate, which is I've got $150,000 at 2.25, $250,000 at 10, or I could have just done one new mortgage at 7.5 on a conventional. And that's where we look at, because eventually you're going to be refinancing anyways. You might as well put them together into one. So again, planning, looking at options.
Yeah, absolutely. Slide. All right, here's another good objection. It's easier to buy a property if I have a co-signer. And even before this call, Brett and I were hashing this one out because this is a myth and it's a fact. And the reality is, on the surface, there's no way that adding more people to a loan doesn't make the loan more complicated. So from an efficiency, from a simplistic perspective, you could argue that it makes the loan more complicated. But if everyone's got their ducks in the row, if you've already got all your paperwork all neat and tidy or whatever, then like even having two people still might be easier to deal with on our side of the fence than it would be for one person who just doesn't have their ducks in a row. Yeah. But the bigger thing is, go for it, Brett.
I was gonna say, sometimes when you have a cosigner, you got to have a cosigner for the income. Okay, so if you've got a spouse, a married couple, they're trying to buy a property, and let's say one person is a doctor and the other person is a barista at Starbucks, and the one person, the barista at Starbucks, wants to buy a house. It's going to help having the doctor on the loan to increase the income and the buying power. Same thing with sometimes getting a parent to co-sign. It's super, specific based on each individual person. If you've got a situation where it might be easier just to keep the doctor and not have a spouse on there, because then we're not pulling two credit reports with two possibilities of two negative, an extra negative credit score or extra debt hitting the DTI. I've seen times where you pull that second person's, credit score and they've got an extra secret $40,000 in credit card debt that the other person doesn't know about. It's always a fun conversation to have.
Fun surprise. That's a fun call that we got to make. We have to be the one that exposes.
Yeah,
for sure.
Always fun, but it's it's one of those where like it's where sometimes it's always easier to go path of least resistance. It's less time for an underwriter to find something, but sometimes you need the other person on there. So it's just kind of case by case.
Yeah, and I think as far as investment property goes too, being a co-signer goes a long way to, generally define how the partnership is going to go. So we see a lot of this, co-signer scenarios on investment properties between like business partners, and it can be really important to make sure you've got a pretty solid plan with whoever your potential business partner is, that if you get into these types of scenario and there is one of the partners that's damaging the scenario a little bit more than the other person is or whatever, that you guys have the ability to have an open conversation about why this transaction, why is the rate all of a sudden super high? Well, because your business partner's credit score is 110 points less than yours, and we have to use the person who has the lower score.
And in that same scenario, and the other thing to think about is, let's say you've got a business partner who's coming to the table with the down payment. Let's say they're bringing $200,000 to the table for the down payment. The other business partner is supplying the credit score. Okay. Well, if we're doing an investment property between two non-married or family members, that person with the $200,000 down payment has to be on the mortgage. They can't come to the table and just say, hey, I'm here with the $200,000 and then walk away. Right. They've got to be part of the transaction. And in the case of an investment property and non-family members, it can't be a gift. They can't just say, I'm gifting to somebody. It's called straw buying. It's a big issue. So in that case, what we always tell people is, like, you do your ducks in a row, deposit the money, let it sit there for 90 days so we don't have to season it.
Yeah. You conjured up a memory. It was like, I think it was like springtime for us. It's just this calendar year that we had some partners. They wanted to buy this house. They'd been shopping for a while, blah, 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 but they had never gotten pre-qualified. They go to apply, and there was a grenade sitting in their partnership arrangement because of one of the people. And they ultimately opted not to move forward with like buying, but it made the partnership really sour, right? Because they hadn't done any of that preparatory work. So if you are considering doing that with the partnership, like you said, Brett, get your ducks in a row. But one of the ducks is, look at what a pre-qual could see. Make sure that there aren't any accidental $40,000 credit card skeletons in the closet of one of your partners that, potentially could really destroy the deal. So, all right, next slide. All right, here's a good one. We got this one a ton through the survey. Now is not a good time to buy because of high interest rates. And we sit on the side of the fence of myth busting this one, because even if house prices have gone down, there are pockets of neighborhoods where we have not seen house prices gone down. In fact, they have been going up, right? But like, for the sake of our conversation today, homes valuated 10 or 20% less than they were 6 months ago. With the way that we've seen rates like rise, the monthly payments are still about the same once you factor in these higher rates. And so if cash flow, which is a huge component of why people buy investment property, period, is an issue, then waiting for the house to come down in value pales in comparison to being able to execute and having a lower interest rate as far as cash flow is concerned. And so we have been seeing a lot of savvy real estate agents buying real estate right now where they are paying top dollar, but they are asking for seller concessions to do either 2-1 buy downs or do a long-term buy down on the loan itself, so that the property cash flows really well. Because once it cash flows well, what do you care, honestly, how much it is? Because the tenants are paying the mortgage off. Now, you do care. I'm not trying to minimize that, but for the objection as to why you shouldn't buy something right now, that is a difficult thing to say is not a myth, because there are a ton of strategies that we are seeing effectively being deployed to augment this change in the valuation of the properties themselves. And of course, playing the long game is the key to real estate. We all know that. And so if you can acquire the property now and address the mortgage itself, you've got time. Once you have control of the property, you've got time to address the mortgage itself. Anyways, Brett, you want to dump any seasoning on this one, man, or do you want to, after we're done with the slides, we can have a harder conversation about where rates are going too.
Yeah, let's jump in, because I've got a couple of things that
okay, go for it, man.
The second part of the conversation.
Let's
get to this, and then
let's get to the slides. Okay, yeah. All right, so next slide then. Yeah, cool. All right, so I've been approached with this. We've gotten some real estate agents who do the Burr method, or some investors that do the Burr method. If you're not completely aware of what the Burr method is, but it's a pretty common investment strategy that's out there: buy, rehab, rent, refinance, and repeat. But the myth is that lenders aren't interested in the Burr method, and that we think that's a total myth. We know a bunch of lenders that don't want to touch this stuff because it requires planning. It requires your ability to understand what are the actual goals for the client to have with that specific property. And so for us, this is a myth, because lenders need to understand the entire plan, from the purchase to the renovation to the exit strategy. And we are passionately proactive, I should say, about trying to make sure that if you want to plan like that, we can help you define it. And a lot of times folks think that lenders aren't interested in it because the lender that they talk to is missing one of the steps. Like they just don't have the capacity to help you. Maybe they can help you buy, but they have no concept of like how to get you connected to a portal of cash for the rehab. They could definitely help you, maybe connect you to someone to rent it, or maybe they could help you connect someone to refinance, but they couldn't do the rent. And so because they can't help you every step, a lot of times they're like, no, we just can't. We don't do deals like that, right? And so we work with a lot of clients that do this like methodology, and we have influence circles. That's the whole point of being in the mortgage space, is to have other people that you know that you could rely on to help your clients get to the finish line. And so we do not do rehab loans. Brett and I don't touch them. We have the opportunity to do them sometimes, but we have a bunch of connections instead of people that we've worked with in the past that we trust, that we've sent clients to that have executed that really well. And so it's about making sure you have like a plan. So any comments on Burr method, Brett?
No.
No.
And we no. It's going to come an hour. I'm just going to shut up for a second, let you get through the rest of the slides.
Oh, yeah. Okay, that's fine. That's fine, man. Yeah. All right. So the final, I think it was like, we've got like two more. My bank told me I'm only qualified for X, right? And we know that a lot of people go their first line in the sand for getting pre-approvals a lot of times is directly from a bank. There are many factors that play into the qualification, especially on investment property, rental offsets, type of property, location, optimizing cash flow for the very specific application that you're like making. And all banks have very specific guidelines that are unique to them on why they're going to approve you for X, Y, or Z. And so as an example, we consistently see this kind of manifest itself. We talked to a realtor, they were qualified for X from a bank for this rental property. We get in, we look at the approval and we do the math, and all of a sudden, no, they actually can qualify for significantly like more. And so I can say without a doubt that this is a myth. It is very unique though for every single individual that's applying, for like how much this myth is separate, is distance from the truth. But the reality is that we always want to offer, we gladly give free second opinions. And so if this has been an objection, or you've got clients that this is an objection for, we'd love to be able to provide that second opinion for you. So slide.
Can I actually go say one thing on that?
Oh, all right. Yeah, go for it, man.
The flip side of that is also can hold as well, which is, hey, I'm qualified for $600,000. Want to make sure that's good. And I look at it and they only qualify for 200. I've had that come up quite a bit.
Yeah.
And, what ends up happening is they like to go the person that gets $600,000 because it sounds better. But, they get to the closing table and I get a terrified call from the agent saying, oh my God, this deal's dying because we haven't, the lender said that they couldn't do X, Y, and Z that they said they could at the original, at the beginning. It's important to always get a second opinion sometimes. I mean, especially if you've got, we live in the world of online broker loans and call centers. There's a real good chance that person that, that qualified them may A, not be licensed, B, might have been in the business for 30 days and doesn't know the ins and outs, may not take into account, a slew of things that might come up in a file that will end up killing their approval. And the last thing you want to do is be a week out from closing when the bomb goes off. So,
Yeah, that's a great perspective, but that's a huge component to this. And you're not wrong. I feel like last month, I had a scenario like that. We had one of our preferred agents called me, hey, I've got a buyer on one of my listings. Lender is kind of fallen through. Would you give this a second opinion? And we looked at it, and it took us,
I remember that
15 minutes looking at the tax return to be like, no, man, there's no way this guy could qualify for this. I'm so sorry. Yeah. Like, hopefully they're not past the point where they lose their earnest money, know? So, all right, next slide. All right. Here's another trick. This is really a trick question. It's totally a myth. My bank will lay out a custom proposal for me. I have never seen banks do this for clients. I feel like it's when we do these custom proposals for all of our clients, we're constantly told, my gosh, no one does this. Our real estate agent partners love it that we do this for our clients. And so we added this one to the myth bucket, right? That we love building custom proposals, showing all the moving parts, monthly payments, cash flow, closing costs, all those types of things. So you can make an informed decision, right? We want to walk you through it line by line. And, perhaps we've been told it's white glove concierge style like service, but when I got into the business and Brett did his brain dump on me the first few years that we were working together, it was like, this is not white glove concierge service. This is how it should be. And so anyway, so if you've got a client that would love this type of, maybe it's called hand holding, but really it's just about making informed decisions. Like what we have been seeing, sadly, a lot of buyer's remorse coming out of like the COVID inflationary period where people were just bidding, leaps and bounds above what the property asking prices were, and the homes aren't worth that much. And so now they've overpaid, they've got a low interest rate, they don't really like the house. Buyer's remorse is a real thing. So make sure your clients have the opportunity, or make sure yourself, you've got the clarity around, why am I buying this investment property? How does it fit into not just my short-term goals, but my long-term goals? I'm going to make sure that you guys feel confident about that. So slide. All right. My bank will structure my mortgage for tax savings and future growth. Myth, right? And if we see anything in there that is clearly obvious for tax saving types of strategies that would make sense, we have a list of CPAs that we will connect you with so that they can lean in and dutifully help you and support you do that, right? It's always our goal to make sure that your mortgage is keeping in mind with future like growth opportunities. And we work with clients that have 1 property, 2 properties, 16 properties. And so those folks, a lot of times we have made connections with, hey, this client, he's looking at buying his second or third property, even if they were both realtors. Hey, we're going to connect you with our other client. They've got like 16, 17 loans out like right now. They've got a huge portfolio. You should talk to them about some of the tax strategies that they've implemented themselves. And so we've not seen banks do that. So we're going to put that in the myth category too. So Brett, you got any thoughts on that one?
Yeah. I mean, we're not licensed accountants or licensed agents or licensed financial planners. So we do our best to like keep our fingers out of the accounting side, the financial planning side, and also out of the real estate side. We let the pros answer those questions. Now, if we see something that they have a question that I can't answer, you better believe I'm sending it back to you, the agent, to an accountant. We might point out something, might see an error on a tax return and say, hey, you might ask your accountant about this thing. But, I've always said that if you have, if I see a mortgage broker answering accounting questions or financial planning questions, I always raise my eye because there's a certain designation for that. And
totally.
I'm not licensed.
Which is like why we get so frustrated all the times when financial advisors try to tell people like how their mortgages like should work, right? Like they're not certified to sell that stuff. So, all right, I'll change the slide to say we will connect you to people that can do tax strategy. So I'll learn from that. that. So anyway, so next slide. Yeah, I appreciate that, Dan. All right, so here's some common questions that we've had past few times we've had this conversation space with some like realtors, right? And you can see my note in here. I still left it for a recorded webinar. Have a Q&A instead. So we can go to Q&A here in a little bit. Let's answer these common questions. So Brad, I'll pretend like I'm asking you the question, right? But is a pre-approval a guarantee that I can buy another property?
No.
All right. Wow.
A pre-approval
like matter of fact, right?
A pre-approval isn't a guarantee of anything. Okay.
Good.
A pre-approval is the idea that we've looked at something, it looks good based on the information that we're provided. Okay. Until we get our clear to close, it's not a guarantee of anything. Okay. And then a pre-approval on this house, and then not, and let's say you close on it, and then 6 months later you want to buy this house, I got to redo the stuff.
Yeah.
So start it over.
All right. Is it easier to qualify for a condo, a multifamily, or a single family property?
That's a trick question. Yes. No. They all have their own.
Funny. These are common questions, though. As crazy as it sounds, like this is still like
it's interesting. Like each one has their own. Each one has their own goods and bads. And condo, you're going to have some. Coming against non-warrantable problems, and if they can buy it as an investment property, multifamily is going to have its own rules with more down payment. Single family property is always, what I tend to always think is, my bread and butter. What I think people should buy is single families if you can do it. But even those have problems, so it just kind of depends. Each situation is going to be contingent on that specific borrower.
Yeah, I'd say every situation is unique and every borrower is unique.
Exactly.
So the combination of the two of those functionally just makes it super unique, right? So,
Yep.
all right, next question. Can I use my money from my business, from my corporation for my down payment?
Sometimes it is going to usually require an accountant's letter stating that utilizing the money, like, you know, your accountant who has been auditing your doing your tax returns and knows your finances is going to write a letter that says pulling out $100,000 isn't going to affect the business. And if you can do that, you're cool.
All right. This one is probably the biggest question on here when it comes to investment property that we get asked, or I should say that people don't realize that they don't know. But do I need a tenant in the rental property that I'm buying?
No, not with conventional. So, like, again, you can't do a rental property with FHA or VA. Okay,
Right.
so we're talking conventional here. What we're going to do is we're going to have what's called it's a okay, what's the term? It's a rental appraisal, essentially, where part of the appraisal package is the appraiser taking into the rent rolls in the area, and they're going to give us a kind of a little swath of what they think the rent's going to work, and then we use the lower of the two numbers. It's like if it comes back and says that the average rental income for this type of property in this area is $2,500, sweet. That's the number we get to use as income on the property that you're buying.
We're not going to do any questions. We're not going to do any questions today because we're over time.
And I'm just rambling. I'm sorry.
Thanks for everyone else who is on Facebook and in Zoom today to join us for the Be the Better Agent Mastermind. We will see you on every first and third Thursday of the month at 2 p.m. Mountain Time. Until the next one, guys. See you later.
Bye.